Forex versus CFDs. Most people think it's a choice. It isn't. Here's the real question.
You're deciding whether to trade Forex or CFDs. Most guides treat them like two different products. They're not. Outside the United States, retail Forex IS a CFD. Same wrapper, same contract, same legal structure. So the question most beginners are asking, CFD or Forex, doesn't actually exist. The real question is Forex CFDs versus everything else. Stock CFDs, index CFDs, commodity CFDs. That's where the cost gaps live. That's where the risk gaps live. And that's where the leverage rules flip in a way that catches people out, including one paradox we'll get to in a few minutes that costs traders money every earnings season. So let's pull it apart properly. First, why retail Forex became a CFD in the first place. The mechanism matters. The real Forex market, the interbank market, runs on prime brokerage accounts with multi-million-dollar minimums. Banks trading with banks. You, with a $500 account, aren't getting in. Ever. So retail brokers had a problem. How do you give a normal person access to a market that legally won't let them touch it? They built a workaround, the contract for difference. When you buy one lot of Euro-US at Pepperstone, no euros change hands. Pepperstone writes a contract that says, if Euro-US rises 1 pip, you get $10. If it falls 1 pip, we get $10. That's the entire trade. The price quote comes from the real interbank market. The transaction itself never touches it. So retail Forex is technically a CFD everywhere except the US. The wrapper is a contract, the price is real. That's the setup. Now the comparison that actually matters. Forex CFDs versus stock, index, and commodity CFDs. Same wrapper, very different math. Start with cost. Euro-US on a raw spread account, say IC Markets, is roughly 0 pip spread plus $7 commission per round trip lot. About $7 to open and close a $10,000 position. Same notional in an Apple stock CFD at Pepperstone, you pay roughly 0.1% spread on each side plus 0.1% commission on each side. That works out to about $40 on the same trade. 40 versus 7. Forex is cheaper per turnover by roughly an order of magnitude. Trade once a month, you barely notice. Trade every day, that gap becomes your biggest cost line, period. Okay, Forex is cheaper, so it must be the riskier one. Higher leverage, bigger blowups, right? This is where most people get it backwards. In the EU and UK, the leverage cap on Euro-US is 30 to 1. On a single stock CFD, 5 to 1. 6 times less leverage on stocks. Common sense says lower risk. It's not. Here's why. Euro-US on a quiet day moves about 0.5%. On a loud day, 1.5%. The last time it moved 3.3% in a single session was the Swiss franc unpegging shock. That was 2015, 11 years ago. A mid-cap stock can gap 10% on an earnings miss, overnight, through your stop loss, in seconds. That's not a tail risk, that's any Tuesday in earnings season. So at 5 to 1 leverage on a stock, a 20% earnings gap wipes your entire margin out. Negative balance protection is literally the only thing keeping your account from going below 0. At 30 to 1 on Euro-US a 3.3% move does the same, except Euro-US hasn't done that in over a decade. Here's the counterintuitive bit. Forex CFDs look more dangerous on paper. The leverage cap is 6 times higher, but in practice, stock CFDs blow accounts up more often. The 5 to 1 cap masks a much bigger jump risk distribution. Lower leverage, higher catastrophic risk. That's the trap nobody explains in the disclosure docs. So which one should you actually trade? Trade Forex CFDs if you're learning. The market is deep, liquid, and resistant to overnight gaps. Trade Forex if you want the lowest per trade cost. Trade Forex if you like macro catalysts, CPI prints, central bank decisions, non-farm payrolls, and you're comfortable being concentrated in interest rate and macro exposure. Trade stock, index, or commodity CFDs if you have a sector view but don't want to own the shares. If you need a temporary hedge on a real portfolio. If you're fluent in earnings mechanics and can read a guidance miss before it gaps. If you specifically want leveraged exposure to equities and you accept the 5 to 1 ceiling. Trade neither if you want long-term wealth building. CFDs are not for buy and hold. Use a real cash brokerage. Own the actual shares. Collect the actual dividends. And here's the line every regulator forces brokers to print on their website. Between 70 and 85% of retail CFD accounts lose money at every major EU and UK broker. That's not a marketing failure, that's the base rate. If you can't articulate your edge in one sentence, you're inside that 70 to 85%. Now jurisdictions, because the rules change depending on where you live. United States, retail CFDs are banned, flat banned. US residents trade OTC spot Forex through OANDA or Forex.com, both regulated by the NFA and CFTC. Leverage capped at 50 to 1 on majors. Stock speculation goes through options and margin at a US brokerage. Different products, different rules. Australia, CFDs are allowed, but ASIC matches the European caps almost exactly. 30 to 1 on major Forex pairs, 20 to 1 on indices and gold, 5 to 1 on single stocks. Same playbook. Offshore brokers, registered in St. Vincent, the BVI, the Seychelles, will offer you 500 to 1 leverage, sometimes more. That isn't a feature, it's a red flag. The leverage isn't the gift, the lack of regulation is the bill, and you pay it the day something goes wrong. One last question, because it always comes up. Can you trade real Forex, actual currency, not a CFD? Outside the US, not at retail. You can replicate it synthetically using a currency ETF inside a normal stock brokerage, but it's only leveraged if you use margin, and the costs aren't competitive with a tight Forex CFD. Inside the US, OANDA and Forex.com deliver actual OTC spot Forex. Economically, it behaves like a CFD. The legal wrapper is just different. So here's where it lands. CFD versus Forex is not a real choice for most retail traders. It's a category error. Forex is what you trade. CFD is how it's packaged. Outside the US, they're the same thing, and the moment you internalize that, the real questions come into focus. There are 3 of them in this order. 1. Which asset class actually fits your edge? Currencies, stocks, indices, commodities? That's the real choice. 2. Who regulates the broker? Tier 1, FCA, ASIC, SciSec, or offshore. That determines whether you have recourse when something breaks. 3. What's the total cost? Not just spread. Spread plus commission plus overnight financing. Add it up over a month. That's your real number. Remember the cost gap, $7 versus 40 on the same notional. Remember the leverage paradox we promised at the start? 30 to 1 on Forex is safer in practice than 5 to 1 on stocks, because volatility, not leverage, is what blows accounts up. And remember the base rate, 70 to 85% of retail CFD accounts lose money. If you can't say why you're in the other 15 to 30%, you're not. Pick the asset class first, pick the broker second. The wrapper takes care of itself.
Forex versus CFDs is the wrong question. Pick the asset, then the regulator. Full breakdown in the description.